Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 4th, 2023. Hope everyone is doing well. Hope you had a good trading week, and thank you so much for coming and visiting me for my weekend review podcast. In this podcast, the format is going to be as follows. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back and we're going to take a look at all the trades I made last week, both on the daily and the weekly time frames. We're going to talk about when I entered the trade, why I entered the trade, what strategy I was using, and then most importantly, how I am going to manage the trade going forward, whether it goes my way or the opposite way. And it's very important in trading, everyone, that you can create a plan using good trading fundamentals and strategies that look for rejections of certain levels, position sizing correctly based upon the volatility of the market and the amount in your trading account, having a very good risk to reward ratio, having an emergency stop if things really go against you in a bad way. I also like to take partial profits if the trade that I am in is starting to move my way. Not the whole thing, just a small percentage of what I have so I can lock it in, which reduces my position size, which just reduces my overall risk. And then there are certain levels above that when I get to those levels, I go into trailing stop mode to further reduce risk and to further tighten my stop. Um, so it's very important to have a plan and that you follow the plan, because you never know what the market's going to do, but you have to know exactly what you are going to do regardless of what the market does. It's very, very important. So find yourself a good trading approach using good trading fundamentals and good trading strategies that incorporate these things, because over time, if you enter a trade at a major rejection level and you're wrong, but you're wrong small, that's fine. But eventually you will get into a trade that really moves your way in a big way, like it did last week. And then you have some big gains that are going to pay for all those small losses that you're inevitably going to have. So anything can happen in the short run. But what's important is that you use a good trading strategy that incorporates what I just mentioned, so that over the long run, those larger wins pay for those smaller losses. And that's how you make money in trading. All right. So again, we're going to look at my trades on both the weekly and the daily time frames. We're going to talk about when I entered the trade, why I entered the trade, how I am going to manage the trade going forward. After that, I'm going to spend a few minutes. We're going to talk about trading psychology. It is the most important skill in trading, everyone, bar none. Is the ability to, you can have the best trading plan in the world, you can use the best trading principles in the world, but if you don't follow it, then it's just completely useless. So everyone talks about, oh, I've found this strategy, and it doesn't matter. You can have the best strategy in the world, but if you don't follow the strategy, it's all for naught. So that's why I like to talk about trading psychology. It's helpful for me to talk about it in my trading, and I hope it is going to be helpful for you as well. After that, I have gone down through my master watch list, and I have identified some trades both on the weekly and the daily time frames that I am interested in for next week. Now, they're not where they need to be, because if they were, I probably would have already taken the trade. But I have to be patient and wait for whatever market that I'm looking at to come down, and it will either has to go up to show some upward momentum, or it has to come back down and reject some level below. So I like to do this on Saturday when the market's closed, everything's quiet. I just go down through the master watch list very calmly and patiently and go, oh, this one, if it gets there, then I would be interested. It's not there yet. If it doesn't get there, then I just don't take the trade. But if it gets there and everything lines up, then I take the trade. Patience is such a huge, important part of trading. Waiting for the market that you're looking at to get to the level that you want without getting impulsive and just getting in for no reason. You have to have levels rejected that offer good risk to reward ratios. Okay, so I've identified some on the daily, I've identified some on the weekly. Right now with this big market rally that we had last week, this is kind of a very dangerous situation, because yes, everyone's buying. There's a feeding frenzy to buy. Does that mean you should just jump in and buy? My answer would be no. I think this right now with this move that we've had, you have to be very, very careful. Can it keep going? Sure. It can definitely keep going, but we could also reverse as well. So, try to discipline yourself not to get caught up in FOMO, fear of missing out. Because right now, and I'll go through this, I'm going to go through the indexes and some other markets that affect the market. But to me, this rally could turn around quickly, and so be patient. And I would caution you just about buying into this momentum because I'm seeing some things that are showing me that this may stop soon. But I'll go through that as well. All right, so that's what we're going to do. That's going to be the plan. Let's get this U.S. legal disclaimer out of the way, and I will be back in about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding through that with me. And hey, by the way, if I cough during this podcast, I apologize. I've been really sick. I've been really sick over the last 10 days. It's getting old. I want to go outside and do something. Man, this is something. So anyway, my apologies if I cough during this podcast like I am right now. Okay, let's get started. First position that we're going to go over is the SPY, SPY. I bought this back here on the 30th of October. Why did I buy it? This is called a deep dip buy approach. What we did on the day that I bought it down here at 414.80. Why did I buy it there? Well, for a couple reasons. One, you see the orange line here. This is the 300-day moving average. This is an important moving deep dip buy average. The day before it closed below, so it's a no-go zone for me. And it also closed below the 30 RSI. So definitely cannot get involved. But the next day that we moved up, not only did we close under the 300 and then close back above, that's a buy signal just by itself, but it also closed below 30 and then closed above 30. Everything in my trading really comes down to the important concept of multiple confluences, multiple signals happening at the same time. The under 300 over 300 is a signal just by itself. But the under 30 over 30, which is also a signal by itself, now we have two of those, under 30 over 30, under the 300 over the 300. So that's why it's so important in your trading, in my opinion, to wait for confluences of signals to happen. It doesn't mean it's going to be a positive trade, but it's going to increase your chances of having a positive trade. And you can see that's why I took the trade. Took the trade here at 414.80. My end of day stop. Well, why did I take the stop? Well, because it went under 30, over 30, under 300, over 300. Whenever I have those two, I always resort back to the major moving average as my stop. So I bought here 414.80. I position size correctly. Let's talk about position sizing real quick. Position sizing is very important, everyone, and it has to do with the market volatility, and it has to do with how much money you have in your account. Let's just take a hypothetical $100,000 account. 1% of that is a good amount for your maximum allowed loss. It doesn't mean you're always going to lose that. Actually, only 5% of the time you are going to. The other 95% of the time, you're going to lose less with your end of day stop. But let's just take a $100,000 account. 1% of that is $1,000. I take $1,000, and I mentioned about position sizing based upon volatility. Well, how do you do that? You look to the 2 ATR. Average true range means how much it's going to move, expected move in any one day. Well, I want to take twice that, and it's 1161. So I take 1% of the total capital. If it's $1 million, 10,000 is your maximum allowed loss. If it's $100,000, 1,000. If it's $50,000, then it's 500. Okay, it just depends on the amount. So 100,000, 1% is 1,000 divided by the value of the 2 ATR, 1161. 1161. Based upon the volatility of the market, it tells me to buy 86 shares. So here, if I had a $100,000 account, I would buy 86 shares. Then I place my emergency stop exactly what the value of the 2 ATR was, 1161. This is this line down here. So if I buy here 86 shares and it moves down $11.61, how much have I lost? Well, I just did the math, right? 1,000 divided by 1161 tells me 86. So if I were to buy here and it went all the way down here to the emergency stop, then I would lose that $1,000. But again, that only happens 5% of the time. The other 95% of the time, if you have a loss, it's going to be your end of day stop. Well, why did I take the trade? Under 30, over 30, and under 300, over 300. So I'm going to base it off the 300. So if the next day, if it would have closed below the 300, I simply would have gotten out of the trade. Would I have lost $1,000? No, only if it came down here. Okay, I would lose much less than that. So I have my end of day stop, which is the reverse of why I took the trade in the first place. Usually I have my emergency stop down here. And then, so these are all based upon, these are all defensive moves, right? Because we have to conserve capital first. Emergency stop, end of day stop. Now I have an orange line up here. Now we're starting to talk about trailing stop levels and profits. So I always put the trailing stop level 1.5 ATRs above my entry. So I put the emergency stop 2 ATRs below. I put my trailing stop level 1.5 ATRs above. And if it ever gets there, and you can see it got there on Thursday. It got above that level. Now I'm in trailing stop mode, which means now in the future, if I have a close below a previous bar's low, I will sell half of my position. But that rule does not come into play until we get to 1.5 ATR trailing stop level. Now, I also take partial profits based upon the reading of the 0.45 ATR. Right now it's 261. So I would take the current close of the bar, 434.69, add 261 to it. That will be my first profit target on Monday. I'll take my first profit target, add that value to it again. That will be my second. And then I'll take my second, add that to it again. That will be my third. I always place 3 standing limit orders in the market for the next day to take off 10% of whatever I have remaining. Okay, that is an offensive move. Your end of day stops, your emergency stops, your trailing stop level where you get a close below previous bar's low. These are all defensive moves. But as any great sports team knows, you have to play offense and defense. So the stops and the trailing, those are defensive. Taking partial profits as it moves up, that is offensive, okay? And then now we're at a 58.17 RSI. If we get up to a 65 RSI level, now the 5 EMA will come into play. That's even a tighter stop. And if we get to 65 and then we close below the 5 EMA, then I get out of the entire trade. If we get up to the 70 RSI and reject the 70 RSI, then I sell half of whatever I have. And then to fully get out of the trade after rejecting the 70 RSI, if I have a close below a previous bar's low after reaching the 70 RSI, then I am completely out of the trade. And I know all these rules probably sound difficult. How do you remember all those? Well, it takes some time, but honestly, it's really not that hard. And I just do want to mention that I do teach a private one-on-one course in the evening time via Skype. I've been trading for 28 years. I've traded through all the different potential markets that you could even possibly have. And I've been trading a long time and I have a really good approach. I teach 5 different trading approaches in my course. I've taught people from all over the world, from absolute beginners to high-level hedge fund managers. So if you're interested, it is an investment. It costs $1,750, but you get a 15-hour course one-on-one with me where I take you through each particular strategy and you will know these rules like the back of your hand. So if you're interested, I know you're going to be happy that you took the course. All the students I've had over the years have been very happy they've taken the course and they've learned a lot. They've really learned the skill of trading. So my email is in the description of this YouTube video. Just go ahead, send me an email, and we can start talking about setting you up for lessons. All right. So back to SPY. Under 30, over 30, under 300, over 300. I position size correctly. I place my emergency stop 2 ATRs below. My end of day stops close below the 300-day moving average. We have reached trailing stop level, which is 1.5 ATRs above. I have been taking partial profits on the way. I'm in trailing stop mode. So now in the future, if we have a close below a previous bar's low, I will exit half of the position. All right, so this particular trade from entry to current price up 4.51%. So it's been a good trade. I was very patient, waited for that confluence of signals, and it's worked out great for 4.51%. Caterpillar. Caterpillar is another trade that I took on the 1st of November. Why did I take it? Again, confluence combination of signals. The day before, we were under the 30 RSI. The day that I took the trade, we closed over the 30 RSI. That's one signal right there. We also, you see the orange line, closed under the 300, over the 300, confluence of signals, bought at 231.60. Of course, I position size correctly. I placed my emergency stop 2 ATRs below. My end of day stop simply a close below the 300-day moving average. You can see we moved up, took some profits, partial profits, moved up again on Friday, took some partial profits, and I did get to trailing stop level, which is the orange line, which means now I'm in trailing stop mode, which just simply means that in the future now, if we get a close below a previous bar's low on Monday, if we close below Friday's low, that's a close below previous bar's low, I would sell half of the position. If it keeps moving up, great, then that rule doesn't come into play. But what will come into play is me taking partial profits as it moves up because we are at trailing stop level. So this particular trade doing pretty well so far for 2 days, up 3.72%. Apologize everyone for the cough. All right, I did get long Merck on Friday. Why did I get long here? Well, this is not a deep dip buy. This is called something else. This is called a return to value V2. You see the green line here and the green line here? This is called the value zone. Anywhere in this area is called the value zone. I want to buy in value, sell above value, or I want to buy below value and usually sell in value. What you don't want to do is buy above value. So here's the sorry everyone. Here's the value zone. Back here on the 26th of October, we closed above the value zone. Then we came back into the value zone. But then I'm looking for sideways motion. I'm looking for consolidation. I'm looking for an equal amount of buyers and sellers. And then my entry signal was on Friday because we formed a V2. Here's bar 1. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. This is the signal. And if you'd like to learn more about V1s or V2s, just go to my YouTube channel in the lessons playlist and look for V1s, V2s. One of the best trading approaches and trading signals that I know of is V1 and V2 entry, and they're a big part of my trading. So I got long here Friday, 103.13. I position size correctly. I placed my emergency stop 2 ATRs below. Now we don't have a moving average involved here. So where is my stop? My stop is a close below halfway of the washout bar. This is bar 2 of this is bar 2 here. Bar 1, 2, 3. 2 goes below bar 1's low. Bar 3 closes above bar 1's close. My stop in the future, my end of day stop, will simply be a close below halfway of this washout bar. You see the pink line here. So if on Monday it closes 1 penny below that, I'm simply out. Of course, I have my emergency stop down here in the worst case scenario, but my end of day stop on this particular trade is a close below 102.30. So it gives me a very good risk to reward ratio. If I'm wrong and it closes below, okay, I have a losing trade, but it's not that bad. Of course, you see the 1.5 ATR trailing stop level above. If we get up there, then I go into trailing stop mode. Regardless of whether or not we get up there or not, if it moves up, I'll take partial profits. Look, 103.38 is the closing price. The 0.45 ATR on this day is 89 cents. So on Monday, if it moves up 89 cents from Friday's close, I will take 10% off. I'll lock that in, reduce my position size. That will be my first profit target. Remember, I always put 3 in. Closing price plus 0.89, that's my first. My first plus 0.89 is my second. My second plus 0.89 is my third. And again, that's the offensive part. So this particular trade up slightly, but it was the first day that I took it. But I really like these return to value V1s, V2s up 0.22%. All right, VIX. Woo, boy, did I have a ride on VIX. I am out of VIX, but this chart will explain to you why the exiting strategies that I use and the partial profit strategies and the trailing stop levels are so important. I bought VIX all the way back here on the 12th of October. Why did I buy this? Well, we had a level of liquidity. We ran it. We broke to the upside, putting us into a bullish market structure. This green area in here is the fair value gap. This is the place that you want to buy after you break market structure to the upside. You can see we got down here, rallied. I bought here because we came down into the value zone. We created a V1. A V1 consists of 2 bars. Bar 1, bar 2 goes below the low of bar 1's low. Bar 2 closes above bar 1's close. This was my entry point, 2281. This was a V1, so the orange line here, halfway, that is my end of day stop. Here's my trailing stop level, 1.45 ATRs above my entry. Next bar, huge day up. I hit 3 profit targets on this day because of the offensive structure of my trading. So right off the bat, I took 30% off on this day, only leaving me with 70% left of my total position. And you'll see that was a really good move in hindsight. We also got to trailing stop level. Next day we came down, but we didn't close below the previous bar's low. Next day we went up, took some more profits off. Next day we went up, took some more profits off. Next day went up, took some more profits off. Then here was the first time that we had a close below a previous bar's low after reaching trailing stop level. I took half of the remaining shares off for a gain of 11.59%, which you'll see was very, very important, especially where we are now. So I've significantly reduced my position size here. Okay, then we went down. That was the day that I took half off. Then we had another huge surge up, took more profits. Next day, got near the high, again with more profits. Next day, got more off at the absolute top of VIX. So now I still have shares remaining, but drastically reduced. And now, down, 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 down. On Thursday, we had our first close below halfway of the washout bar. I got out for a loss of the remaining shares of 4.11%. So does this mean that I have a loss on this trade? Absolutely not. This was a very profitable trade. Again, because the importance of taking off when the market gives it to you, and the trailing stop level here where I dumped half of what I had remaining. So all in all, this was still a very profitable trade, but it's a good teaching moment of why taking partial profits, why having trailing stop rules made this a positive trade instead of a negative trade. But yes, the small remaining shares that I had left, loss of 4.11%. I'm actually very bullish on VIX again right here, and I'll go through that when we take a look at my potential trades for next week, and I'll explain why. All right, so recap. SPY on the daily up 4.51%, Caterpillar up 3.72%, Merck up 0.2%, and then VIX, the remaining shares, down 4.11%. So those are the daily trades. Let's get over to the weekly trades. Here is gold. Now, weekly trades. Weekly trades will trigger, you'll take your action on Friday because that is when a weekly bar closes. All right, so I bought GLD all the way back here, excuse me, at 169.70. Why did I buy this? Well, two reasons. The main reason was during the week we went below the 200, closed above. We also rejected the negative third ATR channel. 92% of prices, when they come down to this negative third ATR channel, tend to stop going down, go sideways, or move back up. So that was my confluence. An intra-week rejection of the 200-week moving average and an intra-week rejection of the negative third ATR channel. So I position size correctly. I placed my emergency stop 2 ATRs below, and my end of day, not end of day, end of week stop would simply be a close below the 200-week moving average. So this week here went up, but if it had gone down and literally closed below the 200-week moving average, I simply would have been out with a small loss. But fortunately, it went my way. Orange line here, 1.5 ATRs above my entry. This week was huge. I took off, I believe it was 2 profit targets on this big week up. I also got into trailing stop mode. Doesn't mean I do anything, but now I'm in trailing stop mode, which means if I have a close below previous bar's low in the future, I will exit half. The next week we moved up again substantially. I took another 2 profit targets off here. So I'm continuing to reduce my position size, locking in those profits. And the last couple of weeks, we've gone, well, the next week we went up a little bit. I didn't hit a profit target. And then this week was kind of an inside bar. So I have the full position except for what I took off for my partial profits. Next week, if we close below this week's low, I would exit half. We're at a 58.37 RSI. If we move up higher and we get into the 65 RSI level, then a close below the 5 email, I will exit the entire position. Alternatively, if we keep moving up and I reject the 70 RSI, then I will take off half. And then if that happens, if I take off half after rejecting 70, then if I get a close below previous bar's low, I will exit the entirety of the trade. But this has been a really good weekly trade here from entry to current price, up 8.13%. Pfizer. Pfizer is a trade that I took on Friday. I took that yesterday because of a confluence of signals. What were my confluences of signals? It was an under 30, over 30. The previous week, we closed under the 30 RSI. On Friday yesterday, we closed above the 30 RSI. That is the signal. What is the accompanying signal or the confluence of signal? Again, negative third ATR channel. Again, 92% of prices tend to fail, tend to stop going down and head back up, and that's what we did. Previous week, we closed under the negative third. This week we closed over the negative third, and again the main signal was the under 30, over 30. So I got long here at 30.90. I positioned size correctly. I placed my emergency stop again 2 ATRs below. How far is that? 2 ATRs. Average shoe range equals 340. I took my entry price minus 340. That's exactly where this emergency stop is. So for that hypothetical $100,000, if it got down there, I would lose $1,000. Doesn't matter if it's down 12%. That's all you're going to lose is 1% if you position size correctly using the 2 ATR formula. Orange line up here, what is that? That is my trailing stop level. If I get there, then I go into trailing stop mode. And again, of course, I will take partial profits next week if it goes up. Right now, the 0.45 ATR is 76 cents. So next week, if it moves up 76 cents from the close, I'll take 10% off. That's my first profit target. Second profit target is my first profit target, add 76. That would be my second. Take my second, add 76 to it. That would be my third. Very important, in my opinion, to use these partial profits. So anyway, this particular trade, just entered it on Friday, up 1.15%. So pretty good start to that as well. FXY, my gosh, what a ride on FXY. I took FXY last week with an under 30, over 30, and a V1. Things didn't start out so hot tamale at the end of last week for FXY. But I wait till the end of the bar to make my decision. Of course, I have my emergency stop down here. I have my trailing stop level 1.5 ATRs above. Why did I take the trade? Under 30, over 30. Therefore, if this week closed under 30, I would get out of the trade. It was well under 30, you can see, but at the end of the week, it closed at 31.01, so I am still in the trade. Look at the volume that happened on this week. I do think there's a good chance that the low is in on FXY. So this particular trade, after being down substantially during the week, is slightly up 1.16%. I'm looking at the daily here. By the way, you see this blue box here. Why is this? What's this blue box? This blue box is called an island reversal. See how we gapped down? Then we had a sideways, and then we gapped up. Do you see how these two bars are just floating here in space? This is a very strong signal, everyone. It's one of my it's probably my newest, best, favorite signals. Island reversals, abandoned babies, they're extremely strong signals. Look, we look here in the past. Oh, I think I erased it. Look here. Here's an abandoned baby to the downside, showing you that now the market's bearish. Was it bearish? It certainly was. And now look, now we've had it to the upside. If you'd like to learn more about the abandoned baby or island reversal, I have a YouTube video about it. Just look for abandoned babies, island reversals on my YouTube channel, and I did a video exclusively on this. So this makes me very bullish on the daily chart on FXY. But I did trade it from the weeklies with the under 30 over 30. So still above 30 RSI, up 1.16% after a big loss. XLF, oh boy. I was almost kind of hoping that I would be done with this trade because I've been in it for so long and been talking about it for so long. But remember, if I have been in a position for a long time, I guarantee you it means that it has been a positive trade. I'm not going to be in a trade for a long time if it's going against me. If I'm in a trade and it goes against me, I am out quick. I want to be very impatient with my losers, but I want to be very patient with my winners. I have been in this XLF trade, if you can imagine, all the way back March of this year. Why did I take this trade? Well, it's a weekly trade. You see the purple line here? This purple line is the 250-week moving average. On that week, it went down, touched it, closed back above. That showed me that that was my entry signal. It also went under the negative third channel, over the negative third channel. I got long here at 30.71. I position sized. I placed my emergency stop 2 ATRs below. My 1.5 ATR trailing stop level is above. And again, of course, I always take partial profits. So the next week it moved up. I took some partial profits. Reduced the position size, locked in those profits. Next week, did nothing. Next week, up again strongly, took some more profits, also got to trailing stop level. Now I'm in trailing stop mode. Next week, moved up again, not enough for a profit target. Next week, not much. Next week came down substantially, but closed above the previous bar's low. I'm in trailing stop mode, so if it had closed below here, I would have gotten out of half, but it did hold. We never had a close below. Then we had a couple weeks of up moves, and then we finally had the first close below the previous bar's low. I got out, locked in 6.4%, and then we had a month straight up where I continued to take profits. Profits, no profits here. Profits, lots of profits here. So I'm continuing to take off size, right, and reducing my position size. Then we moved down. Then we had a week up where I took some more profit targets off. Again here, took more profit targets off. And then we were down, 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 down. My trailing stop, or my initial stop level was a close below the 250. Last week, look, it went below, but just closed above, kept me in the trade. And then this week was a monster, up 7.41, took off more profits. So this particular trade on the remaining shares currently up 9.06%. All right. I put this chart here for you. I was just talking about abandoned babies and island reversals. Look here. Again, perfect example. We gapped up, then immediately gapped down. That's an abandoned baby showing me that that is bearish. Was it bearish? It certainly was. And then look what happened 1, 2, 3, 4, 5, 6, 7 days ago. We had a bullish abandoned baby. Gap down, gap up, and look at that. Nailed it. It's one of my favorite trading approaches. Everyone go and look at that video that I have on YouTube about abandoned babies. Okay, so quick recap on the weeklies then. Gold up 8.13%, Pfizer up 1.15%, FXY up 0.16%, and XLF up 9.06%. So that's the key to trading, everyone. Being very impatient with your losers, being very patient with your winners. You're going to have losers all the time, but they're going to be small. All right. And you can see through the positions that I've shown you today, if a position is doing well for me, I stay in it. I'm patient with it, and they're usually large wins. When I have losses, they're usually going to be small. And that's what trading is about, everyone. All right, let's talk a little bit about trader psychology. This is from my friend Stephen Goldstein. Please go and follow him on Twitter or X at AlphaMind101. Stephen was a professional trader for many, many years. He's now a world famous trading coach. He has a great podcast where he interviews traders from all different areas of the world, all different skill levels. I was fortunate enough to had been on his podcast and been interviewed twice, but it's a great podcast to listen to. And just go to AlphaMind101 on X. Let's see what Stephen has to say. Markets beat you up regularly. Yes, they do. And then you compound that by beating yourself up for nothing more than getting a random call wrong. The antidote is self-compassion. Forgive yourself and giving yourself a break. Few realize just how much the most successful traders practice this. Everyone in trading goes through this. I just got off the phone with a friend of mine, a student of mine, that had a bad week because last week kind of had an idea of what the markets were going to do and the markets didn't do them. Right? You have to be careful about having a bias towards the market because you can be very strongly bearish and it can just go up. And what do? I mean, the higher it goes, you feel like the more you're going to put on more, right? All comes back to when you're wrong, getting out quickly and following the price action of the market. Even if it goes against what you think the market should do, the market very often does things that we don't expect it to do or that it shouldn't do, but it does. So, best words of advice I can give you, get your ego out of the way and just follow the rules. If you're wrong, it's fine. If there was a legit setup and you lose, fine. But when you get into this shame spiral is when you don't have a signal, you just go against the market because you think it should do something. And then if the market doesn't agree, you're just like, what is going on? And then you get into this, you start beating yourself up. And then that starts this shame cycle of like, why did I do that? There wasn't a signal. I kept doing this and now I'm down all this money. And it just affects everything in your life. So my best advice, everyone, is just trade proper signals. If those signals are wrong, fine. But it's worse to lose money when there's not a signal and everyone's making money on the upside. If you're short and the market goes up and everyone's making money on the upside and you're losing, especially not based upon a real, so just forgive yourself and get back on track. And then Stephen also quoted George Michael, be good to yourself because no one else has the power to make you happy. It's true. Be good to yourself, whether it has to do with trading, relationships, anything else in life. You got to be good to yourself. And as far as trading goes, Be good to yourself by only taking proper signals with proper position sizing, and for God's sake, follow the rules, because you can really get into this downward spiral if you just beat yourself up, and it just kind of goes south from there. So if you've been struggling in the market, everyone, if you've been on the wrong side for whatever reason, you're biased towards the market, just be good to yourself, but be good to yourself by stop doing what you're doing and be patient and waiting for proper signals. A loss with a proper signal is a lot easier to stomach than a loss with no signal and you're just fighting the market. I'm sure those of you who've been out there trading for a while really understand this, but just start over. Start from scratch. I don't care how poorly you've been doing. Be patient, wait for the signals. Over time, if you use proper position sizing and proper trading techniques and good trading principles, over time, you'll make the money back. So if you've had a tough time, start from scratch, right? It's the best words of advice I can give everyone. So thank you, Stephen Goldstein. Again, he's at AlphaMind101 on Twitter. I highly recommend that you follow his channel. All right, I had to take a little cough break there. Sorry. And I am back. All right, let's look. And by the way, after we look through these potential trades for next week, I do want to spend a little time at looking at the markets in general, kind of get an idea and some things we're running into. All right, Apple. Well, Apple had earnings on Thursday. The market didn't like it. They gapped down $6. We recovered here. Still down on the day, which was bearish for Apple. I'm not interested in getting long on Apple here in any way, shape, or form unless we come back down to the 200. So if we come back down to the 200-day moving average, I would consider getting long Apple. It would be a good risk, as long as I have a good risk to reward ratio. Look, here you have a close under 200, excuse me, and then over. Not a great risk to reward ratio. I don't think I would have taken, well, I didn't take that trade. But if we come back next week, bounce at the 200, intraday reject, and or close under, close back over the 200, buying off of the 200 historically on Apple does make sense. So if and only if Apple rejects the 200-day moving average next week, I would consider taking the trade. We did have a 520 crossover here, which is a legitimate buy signal, but I don't like taking crossovers unless sideways motion happens before. And this was just a straight up move here. This is also something I teach in my course, 520 crossovers. And they're good approaches. They're definitely long-term profitable approaches. But I put a filter on these where I need to have some sideways motion before the 520 happens. And this was just straight up. That's what caused the 520 to cross. So not taking that. Also, I didn't like the relative strength of Apple, of it being down on a big up day. So what I'm looking for next week, and honestly, I hope I get it. I would love to buy Apple with a good risk to reward ratio over the 200-day moving average. So if it gets down there, I'll consider it. If it just keeps moving up, then I'll just get on to another market. Anheuser-Busch. Okay, so you heard me talk about bearish and bullish island reversals, abandoned baby. Anheuser-Busch had a huge move up here, but what I'm looking for Monday only is it. See how we on Thursday we gapped up? If Monday, for whatever reason, we gap down, this will leave an abandoned baby for Anheuser-Busch, for Budweiser, BUD. So if and only if next Monday we gap down below the low of Friday's bar, then that will create a abandoned baby. So this is really only for Monday, and I'm not expecting it to do this, but if it does do this, I will certainly get short Budweiser if it creates an abandoned baby. In addition to that, we've had this huge move up. We're over the 6th ATR channel. About 98% of prices fail above here. So I'm not expecting it, but I just did want to point it out for whatever reason over the weekend. If something happens and this gaps down and leaves this bar all by itself, I would get short Budweiser. Dow Jones. Okay, well, Dow Jones, we've had a big straight move up. We closed above the 200-day moving average, and then that signal by itself did work. But what I'm looking for next week is a bit of a pullback, giving me a better risk to reward ratio at the 200-day moving average. It might just continue up, and if it does, then it's a non-trade for me. But next week, if for some reason we do come down, bounce at the 200-day moving average, or an intraday rejection of the 200-day moving average, or a close under, close over the 200, then I would expect that. This move was straight up. I don't like to buy anything parabolic. I would expect a back test and retest of the 200. And if it does that and gives me a good risk to reward ratio, I'd consider getting long DIA. Same thing with MasterCard here. Look at this beautiful signal. Totally legitimate with a rejection of the 300, under intraday rejection of the 300, and intraday rejection of the 30 RSI. Boom. Look at that perfect signal. Don't want to buy here. We've gone straight up. I would expect a pullback and retest of that 200. And if that happens, I'll consider getting long MasterCard. UUP. You know, if you listen to the podcast last week, I was talking about UUP. I was talking about how I felt like this was bearish, and if it was bearish, that it was going to be good for the markets. It's exactly what happened. Let me kind of explain this to you. Do you see the high we have here? Do you see the green MACD bars we have here? Green MACD bars show positive upward momentum. And this is something I learned from studying one-on-one with Dr. Alexander Elder, double tops with bearish divergences. So we have a high here with green MACD bars. Great. We pull back into red. But then you see how last week we were higher than we were here. But you see how there's no green bars? This is called a double top with a bearish divergence. This is why I was bearish on the dollar. And this is what I explained last week, that I'm bearish on the dollar, and therefore that makes me bullish on the market, which is exactly what happened. I do see here that we rejected the 50 SMA here. And so the reason I'm highlighting this today is that we gap down. Monday, if we gap up, it will leave an abandoned baby here on UUP. So the same with Anheuser-Busch, where on Anheuser-Busch, I would get short if we gap down and leave this bar by itself. On the dollar, if we gap up for whatever reason on Monday, leaving an abandoned baby, bullish abandoned baby to the downside, I would consider getting long UUP. And by the way, these double bottom bullish divergences, very, very strong signals. Like I said, I did learn these from Dr. Alexander Elder, one of the most famous traders and authors out there, because I studied one-on-one with him. He believes that double bottoms, bullish divergences, double tops, bearish divergences are some of the strongest technical signals in the market, and I would have to agree with him. And I also do teach this in my one-on-one course. All right, last but not least, XLE. Thursday, we had a big, strong bar above. I wouldn't want to buy this off of the 200 because the risk to reward ratio is not good. But the same with Diamonds and MasterCard. If we were to come back next week and retest this 200, it could give me a good risk to reward ratio. Like this one, look, this is a good risk to reward ratio. Closed under 200, barely over the 200, giving me a very good risk to reward ratio. So next week, if we come down and reject that 200-day moving average and it gives me a good risk to reward ratio, I would consider. So real quick recap on the dailies that I'm looking at. If Apple comes back down, rejects this 200, I would consider getting long Apple. Anheuser-Busch, if Monday only we gap down, leaving this bar all by itself, I would consider getting short Budweiser. DIA, if we come back down and retest this 200, I would consider getting long DIA. MasterCard, if we come back, retest the 200, I would consider getting long MA. UUP, Monday and Monday only, if we gap up above the high of this gap down bar, creating a bullish abandoned baby, I would consider getting long UUP. And again, XLE, if we come back down, reject the 200, I would consider getting long XLE. Now, it's it's conceivable that all of these potential 6 signals could trigger on Monday. Does that mean would I buy all 6 of them? No. I have a rule where I only buy the best signal. So these all could signal on Monday, but I would have to narrow it down to the best signal. How would I do that? Well, it really comes down to the following. How many signals? Like, let's just say MasterCard has 1 signal, Budweiser has 2 signals. Well, I'd go with Budweiser. Maybe Apple has 3 signals, then I'd go with Apple. But it comes down to risk to reward. It comes down to how many multiple combinations of signals were there, what was the relative strength of that market compared to the rest of that particular stock or that particular market compared to the rest of the market. Relative strength is very important. And then how does it look on the higher time frame? These are all things that I teach in my course as far as how to, I mean, you could have 10 signals that were all valid, but you have to narrow it down to the best one. Risk to reward ratio, multiple time frames, multiple signals, relative strength. But again, this is what I teach in my course on how to do that. All right, let's go to the weeklies for what I'm looking at weekly. And I only have 2 of them. Okay. Oh, forgot to write this down. Give me 1 second. Okay, we'll start with Morgan Stanley. Morgan Stanley, this is a legitimate signal actually on Friday because we closed below the 200, over the 200. But is it a good risk to reward ratio? I don't really think so. It's quite extended from the 200. It might just continue up, and if it does, great. I'll just get on to another market. But next week, if we come back and retest this 200, giving me a better risk to reward ratio, I would consider getting long Morgan Stanley. VIX. Let me put this here. I'm going to get rid of all these annotations. So let's see, VIX minus 4.11%. Okay, so let me clean this chart up here. Much easier to look at. I really like the VIX here, guys. Looks horrible, right? Looks absolutely horrible, but I like it. MACD is still green if you consider what's going on geopolitically. Russia, Ukraine, Israel, Hamas. There's a lot of potential for volatility still in this market. But I need to wait for a legit signal. Right now, we are at 34.54. Next week, if we continue to come down and go under 30, over 30, I don't care how great things look, I will take the trade on VIX. So real simple on VIX, on the weekly, next week, if we come down, go under 30, over 30, I will definitely get long VIX. So that's all I have on the weekly. Morgan Stanley, a pullback retested the 200. That would get me potentially long Morgan Stanley. And VIX, very simply, under 30, over 30. So that's what I got. That's what I got there. So let's take a look at the markets in general. Okay, QQQs. Well, obviously we've had a big move up. We have a lot of gaps here that could potentially get filled. I'd be very careful as far as jumping on this train. And why? Well, look at the trend line we have here. See the highs that are connected? For Monday, what do we have? 369. So yeah, we may have another $1 to $3 up on the VIX here, but we're going to run into this trend line. And if you run, it doesn't mean that it's going to reject this trend line. It very well may just continue up, but from a technical standpoint, we are running into this. And by the way, you know, I studied one-on-one with Larry Williams, and Larry Williams taught me something very interesting about trend lines. If the market prior to breaking the trend line, if it's showing you, if it's what's the word, signaling that it's going to break above the trend line, those trend line breaks usually don't work. The ones that work are if we have a down day, and then out of the blue, it surprises everyone and breaks above the trend line. Those trend line breaks tend to work. The ones that are signaling that it's going to break above the trend line, everyone sees it, it's obvious. Those are the ones that usually don't. And right now, we are signaling that we are going to break this trend line. So this concerns me about the market moving higher. It very well may. We had a 520 crossover. That's a buy signal just by itself. But keep in mind, we have this trend line. Look next week about how things are responding to this trend line. Again, if we have a down day and then out of nowhere we break above, those are usually the ones that work. The ones that are signaling that they're going to break, those are usually the ones that don't work. We talked about the dollar before. Again, we bounced at the 50 EMA and the 50 SMA. So if this holds, again, the dollar and the markets are usually inversely correlated. So if we get a move back up in the dollar, we'll probably have a move down in the market. So overlaying that on us coming into this trend line concerns me about the cues. SPY, well, we did get above this trend line here, but it signaled it. But we have another serious trend line here on the SPY, the longer term trend line here. This is, what are we at? 39. Yeah, we could have another $3, $4, $5 to the upside on SPY. But then we are going to run into very serious trend line here. Another thing I want to point out, here's the third ATR channel, here's the second, here's the first. 88% of prices fail at the second ATR, and we are basically getting right there. So the trend line above plus the second ATR makes me feel like we may have run our course here. So please be careful about just jumping in on this momentum. Okay, to the upside here, one thing that was very, very positive on bonds, and actually bonds have been my very favorite long-term position. Look at the double bottom we have here. See the low we have? See how deep the red bars are? Then we rally into green. Now we've come lower. See how we were lower? The MACD bars here are not as deep as the first, even though we were lower. This was pointing out this is a double bottom bullish divergence, and very likely that this is very bullish that we were going to go up. And you can see interest rate prices or bond prices went up, which makes yields come down. And that's why we had a rally on the market, everyone, is because of bonds. Everything is affected by the price of bonds. Bonds here did reject the 50 EMA, had a bearish reversal. If bonds head down, the market will probably head down. So that's why I'm saying please be careful on the indexes. We've had a huge move. We're running into resistance. The dollar looks like it may rally from here, which would affect the stock market to the downside. Bonds had kind of a bearish, TLT had a bearish reversal. So this all concerns me. So just be very careful. All right. So anyway, I hope that you found this podcast helpful today. If you did, I would appreciate it if you could hit the thumbs up button. Just takes a second, really helps out the channel, lets YouTube know that there's some valuable content here. So if you found something valuable, I would appreciate you hitting that. Again, if you're interested in one-on-one lessons, I teach a great course. I teach you all 5 of the trading approaches that I use. I teach you step by step. Learning one-on-one with someone is always the best thing, in my opinion, whether it's baseball, guitar, stock trading, and that's why I offer these courses. It does cost $1,750, but again, it's an investment in you, and it's worth every penny. And all you have to do is reach out to me. My email's in the link. If you like online courses, I have a great online course. I've sold so many across the world. I've gotten so many good reviews and ratings on that. I think it has a 4.8 out of 5 rating, and it's very affordable. It's only $12 or $15 on udemy.com. That link is in the description as well. So if you want to get started, don't have the money for the one-on-one, then that's a great place. I teach you the deep dip buy stock trading approach. There's 9.5 hours of video in there. There's 26 videos. There's 15 study guides, and it's a great place to get started. And then I always like to leave off, listen, everyone, we could always make the world a better place. And if we just went out and did one nice thing for another human being today, it would make the world a better place. There's no doubt about it. It would. And we like when people do acts of kindness for us. So why don't we flip the table and do something nice for everyone, one person? Just try to do at least one nice thing per day. It's good for the person. It's good for you. And if you could also do it for animals, I would really appreciate that. They appreciate acts of kindness. So one nice thing for another human being, one nice thing for an animal, good for them, good for you. It's a win-win all the way around. So thank you for coming here today, everyone. I really appreciate it. I hope you learned something valuable. I hope you have a nice weekend. Hope you have a good trading week next week. Please be careful next week, everyone. I feel moved to tell you this for the reasons I just explained, but I think we could be getting a little toppy here. So reject the urge to have that FOMO because the market's moved quite a bit. All right, just follow your signals. Be good, be safe, and God willing, I will be here next week, and we will see what's happening with this crazy market. So thanks again, everyone. Appreciate you. Have a good weekend, and take care. And on the way out here, I have to run the U.S. legal disclaimer. Bye.
U.S. government required disclaimer. Stock options futures appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.